Alright guys, so I hope you're doing fine as always. Today I'm making another video about retail traders versus institutional traders. This was requested on the Discord server, so without further ado, let's jump straight into the video. So in this video, we will be going over the key differences between retail traders and institutional traders. We will have a deeper look into how institutions do exactly trade compared to the normal retail trader like you and I. So I would love to start this video with a disclaimer, meaning not everything in this video will be used at every single institution. There will be things that I'm missing in this video. There will be things that some institutions don't do. There will be institutions that do more or less. At the end of the day, these are still companies that do whatever they want. So this video is purely based on information that I got given by my mentor, who was an institutional trader, and by some of my friends who are institutional traders at some of the banks here in Europe. So again, this is just a general overview. There will always be some smaller or bigger institutions that do things differently, but this video is, generally speaking, some difference between retail and institutions. So first of all, we need to have a quick chat about who are these institutional traders and what is considered retail traders. So institutional traders are organizations which either trade on behalf of their clients or for their own balance sheets. Examples of this are hedge funds, digital asset management firms, venture capital firms, banks, and so on. A lot of times these also get referred to as whales. On the other hand, we have retail, which are the individual investors. Usually it's small capital traders like you and I. It's people with a few $1,000, a few $100, and so on. Keep in mind there's also whales in retail, so individuals who have a few million to play around with. So now, what are the key differences between both? First of all, the capital and the trade size. So institutional traders, they have a substantial capital which leads to large volume trades. They will often do these trades through OTCs or over-the-counter desks to avoid big slippage. Because their position is so huge, their slippage would be crazy if they did it through normal exchanges. Because they have this big capital and large trading volume, they will have a big impact in prices themselves. And this especially in less liquid altcoins. So big orders on low liquid coins will have a massive impact on price itself. On the other hand, we have the retail traders, which mainly have this small capital, with the exception of the whales. So what's their advantage? They don't really need to look at available liquidity, because usually, because of the low capital, there will always be enough liquidity to fill their orders without too much of slippage. There's of course also a difference in resources and expertise. So institutional traders, they usually have dedicated research teams within their firm or within their company. These teams will look at all type of things: news events, social media, newsletters, even credit card details, for example, and so on. They also have in-depth blockchain analytic tools, which we will go in further in this video. They have access to proprietary data and insights as well. And of course, they are experts in the field. They get recruited because of their skill and their studies. They need to do these tests, they need to do these practices so often that they become experts in the field. On the other hand, the retail trader is just relying on publicly available information. So the news that we get publicly, we don't have the inside data or news like the institutions do. And also retail traders rely on basic charting tools compared to the advanced resources that institutional traders have, which we will see further on in this video. In terms of trading strategies, there are huge differences. So what do institutional traders do? A lot of them look for long-term accumulation, so they don't care if price goes against them. They keep on accumulating for long-term investments. They have quantitative trading, which means more or less algorithmic trading. So they have algorithms that automatically trade and learn from the past. They use arbitrage trading, which they need fast execution speed for, so they have a lot faster execution speed than we as retail traders do. They can also be market making, for example. These are also institutions. Their job, on the other hand, is mainly providing the liquidity instead of really trading themselves. Institutions can also do yield farming and staking with big capital. You have venture capital investing, which is funding in early stages of projects, meaning they can buy it super, super, super cheap in the hopes that the project will take off, doubling, quadrupling, tenfold their capital investment. There's also derivatives trading, which are the futures, the options, the perpetual swaps, and so on, and much more. On the other hand, what's the main strategy for retail traders? It's either spot buying and selling or derivative trading, both long and short term, as in scalping or swing trading. Of course, there's also occasionally staking for retail. But in general, these are the main options retail traders do compared to the many options institutional traders have in this market. Now let's have a quick word about the market influence. So institutional traders, their big buys and big sells can move the markets themselves. In order to fill their positions, they will hunt for liquidity. And due to these big orders, they have a big influence in the market sentiment itself. So they have a big say in, are we bullish, are we bearish? Retail traders, on the other hand, have limited to no impact. You can say whales have somewhat of a big impact on weekends because there's no institutions trading on weekends. So in weekends, retail whales could potentially move markets. Another thing we see in this crypto space is that a lot of retail traders come together in some form of pump and dump groups where they try and pump the price of low liquid assets, trying to benefit of mass buying, but at the end of the day, only the people that started this group will profit by dumping their holdings on everyone hoping to get rich in this pump and dump. I think it's also important to look at transaction costs and regulatory oversights. So institutional traders, they have usually lower fees because they have a very high trading volume. They can even have different fee structures with OTC trades, which they can negotiate themselves. But they also have increasing regulatory scrutiny and compliance requirements. For example, AML, KYC, and so on. Because crypto is so new, the regulations are not to point yet, and they vary very strongly across different jurisdictions. So across different countries, different states, other rules can be in place. On the other hand, for retail traders, the exchange fees we get depend on either the platform you use, the volume you have, if you used, for example, affiliate links, and so on. Regulatory for retail is really not there yet. It's so dependent on where you are from, and it's the subject to evolving regulation regarding crypto and taxation. So also tax-wise, it's not very clear yet what you have to do, how it all works. It's really in the early stage, but we see it's taking place more and more. The regulation is evolving, the tax systems are evolving, and so on. We can also have a look at decentralization and anonymity. So for institutional traders, they often have to operate and trade with greater transparency and compliance requirements. Potentially, they have less emphasis on complete anonymity. On the other hand, retail traders, they may, or they are, most of the time, more so drawn to the principles of decentralization and pseudonymity offered by some currencies, DeFi protocols, and exchanges. So, for example, no KYC exchanges and so on. They try and hide their actions and income stream, which institutional traders, of course, cannot do. Now we reach the different trading strategies, which I think will be the most interesting for you. So a little reward if you got this far into the video. First, let's have a quick look at the strategies of retail traders. Retail traders will use basic strategies like trend lines, candle patterns, breakout structures, which has wedges, triangles, and so on. Things like Elliott waves, pivots, harmonics. Very common one is RSI and MACD, or oscillating indicators. I also included vector candles here. It's the strategy that I personally use. We have smart money concepts, ICT, and so on. But if we have a look at institutional traders, the most important tool institutional traders have, I think I can say that, is the order book and the depth of market, also known as L2 or level 2 data. What does this do? Is they look at the bids and the asks themselves and the size, so they can see at which level, which price certain big positions enter the market or leave the market, and so on, which helps them assess the liquidity, the available liquidity, so they can try and scale in their orders. They can see if there's enough liquidity to fill their orders, and so on. They can also use this to identify strong support and resistance levels, so they can see where other big orders are coming in, where other institutions are trying to enter or exit the market, and so on. With this information, they can anticipate price movements, so they can detect what we call iceberg orders. So they try and identify other institutional activity and try and anticipate on that. With this data, they will be developing algorithmic trading strategies. These algorithms can analyze the order book themselves in real time to try and identify certain patterns in order to anticipate on that or take advantage of that. With this data, they can also, of course, try and front-run other institutions. This in the space is considered unethical, and it's also not allowed in regulated market like stocks, bonds, forex, and so on. So only a matter of time before this is also not allowed in the crypto markets anymore. Keep in mind, this is very unethical. There's somewhat of a gentleman agreement that they won't do it. Of course, there's also always rogue agents who will do it, but it really ruins your name within the space. Here we have some examples. I think if you follow the channel, you will know this. This is the bookmap. It shows a current order book. It shows your session volume profile ranges, your chart volume profile ranges, the volume. You can see if it's being spoofed. You can see the transaction amount and so on. So this is an example of depth of market. Of course, there's many other tools to check depth of market as well. Another form of depth of markets are footprint charts, which is also commonly used in banks. Footprint charts allow traders to look within the candle itself. It can see the different transactions taking place within the candle itself, for example, so at all the different price points within a single candle. It can show the bits of the asks, it can show the volume, it will show you the deltas of the two, it will show you the point of control within the single candle, it will show you closed auctions, for example, and much more. Keep in mind, this is very advanced stuff. People will practice this for a very, very long time in order to use it. So for retail traders, this might look extremely strange. So here's an example of the footprint charts, but for just volumes. Institutional traders will also just use basic levels to trade. So they buy basic levels, which are, for example, simple round numbers for Bitcoin. They will say, I like 95K. I will place a buy order at 95K. If it goes down, so be it. I will DCA. I have a lot more capital available, so I can withstand this drawdown. I expect price to go up eventually, so this is a nice level to have a first initial buy. If we go lower, I will buy some more. I do have my risk management models in place. I do have the margin, so who cares? They will also buy psychological levels. A big thing they look for are liquidity levels, as they need certain liquidity to enter the market. And like I said, they DCA their entries consistently. Very known example is MicroStrategy of Michael Saylor. He is just consistently buying Bitcoin every month or so. I don't know exactly, but consistently buying, not caring too much about price itself. Because he will hold it for the long run, they don't care what price does on the short time. What else do? They might do order flow analysis, which goes hand in hand with the depth of market. And very important to understand is institutions have no time to wait on indicators. They don't look for confluence or confirmation. Waiting on confluence and confirmation usually means for institutions they miss the boat, because by waiting they only increased their risk and decreased their rewards. Of course, there are other tools that they can use, like foundations and technical analysis, like support resistance, trend lines. Keep in mind, these zones are set up by the institutions themselves, so they have the foundation of these technical analysis. They know if I reverse prices here, retail will draw a trend line, they will jump in, so we trap some liquidity. Keep in mind all the tools we use as retail traders are known by institutions, are abused by institutions, and are set up by institutions in order to create liquidity. Always remember, in order for someone to win and to make money, someone has to lose money. So for institutions to win money, there has to be someone who loses money, which most of the time will be retail. Another advantage that institutions have are customizable workspaces, so they can set up their own form of trading view in brackets with the inflow of real-time data, which we as retail lack. They have fixed connectivity, which means they have very, very high speed communication with exchanges or OTCs. Like I said before, they have the real-time news and data feeds, which we usually lag behind. So we get to hear the news after institutions already know it and priced it in. They have alternative data, which means they have access to sources like social media sentiments. They can see if something is very popular on social media, if there's some rumors going on, etc. They can even look at credit card transaction data to check what the sentiment is, what are people buying, what are people selling, and so on. For crypto, they will also be looking at day volume, week volume, month volume, hype, and so on. Like I said before, they also have their in-house research and analysis team who take care of all the previous mentioned things. They will make this whole study in groups, putting all their brains together, while we as retail have to figure this out on our own mainly. They also have liquidity aggregation. These are tools that aggregate the liquidity from various sources into a single view, which allows them to find the best prices and execute large trades efficiently. So they will look what platform has the most liquidity available, which is the best platform for me to place my trades so I have the least amount of slippage. And like mentioned a few times in the video, they have OTCs which they can use. Of course, institutions also have their risk management in place, which if you follow my channel and the Discord server, you know it's extremely important to me to have good risk management. How do institutions do this? They have a portfolio-wide risk analysis. So they will have a very diversified portfolio, which allows them in return a lot of drawdown on certain coins. So let's say coin A goes up 30%, coin B goes down 20%, coin C goes up 5%, and so on. So they can withstand a lot of drawdown, unless retail traders with very limited capital, we will get liquidated quite quickly or stopped out quite quickly. What else do institutions do? They do stress testing. What does this mean? This is that they simulate extreme market scenarios. So they take care of their portfolio and they check now what will happen to the portfolio in extreme scenarios. So let's say we drop instantly 20-30%. What happens to the portfolio? Are we risking too much? Will we still be liquid enough to cover this? Will we have enough margin? And so on. They use this to test the resilience of their portfolio and to identify potential vulnerabilities, which they will in return scale out or scale in more as needed. They also have compliance tools. So these are systems that ensure that the traders are following regulatory requirements and internal risk management policies set up by the banks, by the hedge funds, etc. Next, we have maybe one of the biggest strategies that institutions can use that we as retail traders just cannot use as we don't have the speed to do this, unless we have some type of trading bots, which then still probably won't have the connectivity that institutions do. This is arbitrage trading and its core principles. So core principles are that it's simultaneously buying and selling. They do exploit market inefficiencies. Arbitrage trading is considered low risk, but it relies heavily on speed and technology. So we, with our human reaction speed, cannot do this. These are four of the most commonly known arbitrage strategies. It's cross-exchange arbitrage and DeFi arbitrage. This pretty much means they buy a certain coin on platform A and they sell it on platform B, because there is this little price difference. Let's say on platform A they pay 101 euros, while on platform B they can sell it for 102, 103 euros. With high volume, this can lead to very, very quick profit within seconds or minutes. These platforms can be decentralized exchanges or centralized exchanges. Because all these platforms have their own order book, this can be abused by trading bots, which we call then cross-exchange arbitrage. In this strategy, they will also or can also integrate some type of forex. So they can buy in a currency A and sell in a currency B. I remember one of my friends who works for a big investment bank in Germany told me they will buy stock A in Indian rupees, sell it at US dollars, for example, to make a quick profit based on the small price differences within the different currencies, and so on. We have triangular arbitrage. This is a strategy where they exploit the price discrepancies between three different trading pairs. For example, between Bitcoin USD, Ethereum to Bitcoin, and Ethereum USD. So they will try and use/exploit the small price discrepancies between the three pairs. So this means exchanging very, very rapidly between the three of them. We have statistical arbitrage. Here they identify and trade on temporary mispricings between historically correlating assets. I won't go too deep in this, as this is probably one of the most complex versions of arbitrage, and in all fairness, I don't fully get it myself, if I'm being honest. This is so complex that I cannot follow whatever they say. We have futures arbitrage. This is also used pretty commonly in crypto. This is exploiting price differences between the spot prices and its future contract. So for example, if there's a big price difference between spot and the perpetual or the future contracts, they might buy the spot and short the futures, or they sell the spot and long the futures. It's always the opposite. So that was in a nutshell how institutions differ from retail traders, how they have advantages over us, how they pretty much laugh at us doing technical analysis. Yes, they can do some themselves as well, but it's definitely not their core decision making. So what can we conclude out of all of this knowledge? First of all, I would love to start with don't compete against big money. We will never win against big money. That's just a fact. They have more info than us, they have better strategies than us, they are faster than us, they have faster transaction speed than us. So don't try and compete with them. Instead, try and join them. try and look for their activity, try and take some crumbs off the pie that they leave behind. There are also advantages that we have as retail trader compared to institutional traders. For example, institutional traders, they must trade. It's their job, so they can't say, I'm skipping today, I'm skipping this week, I'm not gonna trade much this month, because they get paid to trade. We can, for example, perfectly wait for price to bottom out or price to top out. We can also trade trends. We can trade breakouts. Institutions can't do that. They have to do this before the trend is forming, before the breakout is happening, etc. If they wait for this confluence, they're too late to the party, and they can't just market order in because their volume and position sizes are too big. I hope that from this video it's clear that institutions are pretty systematic in their trading, while a lot of retail traders trade with their emotions. They want to get involved, they want to jump in, they jump in without a plan, while institutions are pretty systematic with it. They don't have much emotions, it's not their money that these people are trading with, it's from the company, so of course they might be under stress, but at the end of the day, it's not their own hard-earned money. I hope you also understand that institutions will trade against retail, so they will look for stop hunts to get liquidity for their orders. So there's this very big saying, if you can't see the liquidity in a market, you mostly, or more than likely, are the liquidity yourself. So keep that in mind. Also, something I really want to throw out there quickly in between is watch out for trading gurus. They will tell you, I'm an institutional trader, do this, you'll become an institutional trader, or trade this like an institutional trader, which is bullshit, in all fairness. We don't have the capital to trade like institutions. Stick to being a retail trader, nothing wrong with it, just try and join the institutional activity, but with the capital we own, we will never be institutional traders, so don't try and act like one. A quick word of advice for retail traders: if you don't have a lot of time to chart, swing trading is in theory the best for us as retail because it's less hurt, I would say, by small time manipulation. On the higher time frames, it's a lot more difficult for these institutions to manipulate prices compared to short time frames or small time frames where they can quickly grab liquidity and so on. Also keep in mind, when retail is aggressively selling, someone has to be buying, and that someone is usually institutions. If you're panic selling, someone is buying. Buy the red days, sell the green days. Very simply put, what is it like for institutions? It's almost the same as everything you try and sell. They will buy in wholesale prices. They will try and sell at retail prices. When prices are down, there's usually bad news. Big money will buy the bad news. You will panic sell the bad news. Prices go up. Retail will FOMO in. Big money will be selling into the FOMOing retail, and we repeat. Last thing I would like to repeat is that institutions don't look for tons of confluences or confirmations from these indicators like we as retail traders do, because if they wait too long, they miss the move. It only increases their risk because their entry price will be higher, and it will decrease their rewards because their entry price is higher, so they miss the opportunity to get a better buy. So that was all from me for today. As always, I would love to thank you for watching the video, and if there are any more questions, please leave it in the comment section or on the Discord server, and I will catch you guys in the next one. Take care. See ya. Bye bye.